Good afternoon, everyone. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. I guess you can say I'm back because I think this is our first live show in about 3 weeks. The last couple of weeks due to the holidays and how all things get hectic and parties and events and so forth. I have not been able to be live for the last 2 Thursdays, but I'm back today. And it's going to be an interesting show. I want to talk a lot about what is the big news this week is the Fed. And they made a decision, which by all indications most people would think would be a good decision. But we'll get into the details on that and let you know why that may or may not be true. To start with, as you know, we usually like to give you an idea where rates are with the rate grid on our website. Again, this rate grid is what I call rate indications. Your specific rates that you can get on a mortgage are going to depend on various factors, which don't forget at the bottom of this rate grid, there's a link about mortgage rates where I have a video where I explain in detail how mortgage rates are determined on a transaction by transaction basis. But when you look at this rate grid, good news, bad news, rates are elevated. We're definitely well into the sixes again. Remember, just 3 months ago, we were in the fives. We're definitely back in the sixes. The fives seem to be in our rearview mirror, at least for now. But these historically are not bad. Again, I'll continue to say the mortgage rates kind of get the bad rap. I think in reality, it's more about home prices than mortgage rates when it comes to credibility. But you can see now that we're now in the mid to getting into the higher sixes for conforming loans. Unfortunately, FHA, VA is back in the low sixes. And jumbo loans, of course, also going into the mid and creeping up to the high sixes. So what's underneath? What's determining these kind of rates? Well, Jeff's going to pull up the 10-year Treasury bond chart, and there you can see it. 10-year bond yield right now, 4.575. This is a chart for the last 5 days, and this is not the kind of trend we want to see. You can see last Friday it was much lower in yield. In fact, we were below, I think, 440 just last Friday, 435 in fact, and now we're of course approaching 460. Remember, just 3 months ago, mid-September, we weren't at 460, we're at 360. So mortgage rates definitely are at least 1% higher than they were just 3 months ago. And so you start to wonder what is going on. Why are bond yields going up when we've had since September a full 1% reduction in the Fed funds rate through 3 different moves. First, 0.5% in September, and then a 0.25% in November, and now yesterday, another 0.25%. You would think that would be good news, right? Well, yes and no. So what we're going to do now is I'm going to show you a few of the things that are going on that are causing these bond yields to go where they are. On this next screen, of course, the Fed interest rate decision, 0.25% reduction in the Fed funds rate. That brings the Fed funds rate down to a range of 4.25 to 4.5. Before September, it was 5.25 to 5.5. So again, a full 1% reduction in the Fed funds rate since September, only 3 months. One of the headlines I saw indicated that the Fed's Christmas gift to all of us, to the markets, was coal in your stocking. And of course, you may recall that yesterday the stock market got clobbered. It was down 1,100 points. The Dow Jones Industrial Average down 1,100 points yesterday. It tried to come back a little bit this morning, a couple hundred points. Last check, I just checked it a few minutes ago, the Dow Jones is barely up 15 points. So we haven't really gained any of that loss from yesterday. And the bond market got clobbered again. 2 days ago, the 10-year bond yield was under 440. Now we're approaching 460. So you go, what the heck? Why is it that the mortgage rates and the stock market are getting clobbered with what should be good news? Another 0.25% reduction in the Fed funds rate. Well, a big part of the reason is, first of all, the reduction by 0.25% was expected. And as financial markets tend to do, that was already priced in. It was priced into the bond market, and it was priced into, I think, the stock market. So the fact that it came true, that in itself isn't really the reason why the stock market sold off so badly and why bond yields went up. It had more to do with the commentary from the Fed, from Chairman Powell at the conclusion of the meeting when they announced the decrease in the Fed funds rate. The commentary was all about the Fed is now going to be even more deliberate about going slower on future Fed funds rate cuts. I'm going to say Fed funds rate cut rather than rate cuts, because I want to remind everyone the Fed really only controls the Fed funds rate, a short-term overnight borrowing rate. They don't directly control all rates. So when the media says the Fed's lowered rates with, with an S, yes and no, that's not quite accurate technically speaking. So really the news and what clobbered the bond market and the stock market yesterday was the Fed now saying, hey, look, the economy is doing pretty darn good. And we don't see a need to go too fast on future rate cuts. So that was disappointing to the stock market and to the bond market. The other thing that got released today, existing home sales. It was forecast at 4.1 million after being at 3.96 million in October. The actual number came out at 4.15 million. So basically barely over what was forecast. Although interestingly, the financial news headlines suggest that, oh, we've had an improvement. Well, very, very, very slight. Existing home sales used to run over 6 million on a monthly basis. Now it's 4 million, and that's probably going to be the new normal for an extended period of time. All of the real estate associations across the country are forecasting a drop in the number of real estate agents that are going to be in their associations, people dropping out of the business, and a recognition that home sales are going to continue to be a challenge for probably next year and maybe even the year after. The next big number that's going to come out, not till tomorrow, is the personal consumption expenditures index. That is the favorite target, inflation target for the Fed. The PCE and both the PCE and the core PCE are projected to be higher. So again, part of what's going on here is the expectation that inflation was getting better. It was, and now it seems to be creeping up a little bit. That again is part of the reason why bond yields are actually elevating higher, not lower. And of course, the forecast now for the Fed's inflation target of 2% is that we won't get to that level until 2027, 2 years from now. So that is another factor that suggests that we're going to be seeing these rates at a higher level for a longer period of time, a much different expectation than we thought just 3 or 4 months ago. So with that, we're going to go ahead and go into our next session, where we're going to have a little bit of discussion, Jeff and I, about where do we go from here with this sort of new normal environment. And then, of course, you can see their stocks and bonds get clobbered, and the little bomb much after what happened yesterday.
Hey, Art.
Hey, Jeff, how are you?
Good. So yeah, things are a little volatile if you're in the stock and bond market just a little bit. It appears that the traffic on El Paseo is a little down today. I'm not sure if that means I'm not sure what that means, but it could be the stocks and bonds took a little bite out of their equity. So this is an interesting time. I guess the big thing is isn't a rate cut supposed to be a good thing? I mean, isn't that kind of always what we think? If there's a rate cut, it's supposed to be a good thing. And that's really my driving question I want to ask you is it is, but it's that double-edged sword again. It's like there's some good news, but it's really bad news if you're this type of person. Can you share exactly why the Fed news decision is or isn't a good thing?
Well, yeah, exactly. And it is. It's a good thing, bad thing. The Fed decision yesterday is a good thing. I think the way to think about it is in the long run, because the Fed funds rate, the change in the Fed funds rate going lower will eventually trickle out throughout the economy and have some beneficial effect. But it's going to depend on the type of, on the loan side, on the mortgage side, and on lending in general. It depends on what kind of loan products we're talking about. So, for first mortgages, it had the Fed reduction of 0.25% certainly was not unwelcome, but the expectation that that's going to trickle to a 30-year mortgage going down by the same 0.25% in the short term or almost immediately simply is technically not how it works. And so the consumer over and over again gets disappointed when they hear about the Fed funds rate reduction from the news media, and then talk to somebody like us and we say, well, guess what? Rates are worse after the announcement, not better. And again, the underlying issue there is the bond market focuses not so much on the Fed funds rate, but on inflation data and labor market data. And the Fed commentary underscored the fact that they see a pretty strong economy. They do acknowledge the labor markets, had a little bit of an issue, but not in a substantial way. In fact, layoffs are down quite a bit. So the concern in the bond market is that the combination of inflation not getting closer to the 2% target, it's actually creeped up a little bit the last few months. Plus the fact that the Fed's now saying, well, we're going to slow down on lowering the Fed funds rate aggressively. That is not good news for the bond market, which is what's causing those yields to creep up, and therefore mortgage rates, long-term mortgage rates, going up as well. On the other hand, this is good news for other types of lending. Short-term loans, credit card rates could improve a little bit because of this. And where I think is a bright spot in the mortgage industry is equity loans. Equity loans are generally shorter term loans, both the fixed rate variety. Most of them that we do are 15 to 20-year term. And then, of course, HELOCs. A HELOC is tied to the prime rate, which is directly correlated to the Fed funds rate. So if you have a HELOC, you've enjoyed or will enjoy a 1% reduction in your rate just since September. And if you're contemplating a HELOC, getting one now is still probably a good idea because the rate is lower than it was 3 months ago. And with the Feds now forecasting maybe 2 reductions next year instead of 4, that's still going to be somewhat beneficial for a HELOC. So again, good news, bad news. Long-term mortgages, the rate cut eventually will be good news. Short-term, the commentary about that rate cut, not so good news, but this will help equity loans in a much bigger way than it does long-term mortgages.
Well, it seems like this is a perfect opportunity then for all these people you've talked about in the past that have all this equity in their homes to say, hey, if I want to do some remodel, I want to add some solar, I need to replace things or whatever, this is a perfect opportunity because the money has gotten less expensive. Is that true?
That is exactly right. Yeah, and see this is all correlated, right? Because you've got those folks with the 2 and 3% mortgages out there. They're going to continue in this environment, given what's happened with long-term yields and long-term mortgage rates. They're going to continue to most likely not want to sell. They may, well, I should restate that. They may want to sell, but they feel like they don't want to sell because they don't want to trade a 2.5% mortgage for a 6.5% mortgage. So then they have to kind of calibrate their options and maybe decide that they're going to stay put and then take advantage of the growth in equity that they've achieved and then figure out what they can do where they're at currently rather than selling and buying something else because they just want to avoid that longer term rate.
This is a question I want to ask you because, again, you've got over 4 decades in this industry. As far as this situation where the Feds have lowered the interest rates for short term, mm-hmm. and we have a situation where typically when the rates are higher, what does that do to the home values in a normal market? Does that make them go up or stabilize in price typically?
Well, that's a really good question because the market we've been seeing for the last couple of years doesn't really necessarily track to normal changes. In other words, normally when mortgage rates are creeping higher, and in this case they've gone up quite a bit, they've doubled from 2020 and 21, right? Now, normally basic econ would say, well, if rates go up a whole bunch, that's going to dampen demand for housing, which is going to cause the value of housing to drop. And that's frankly what we all expected. But unlike past cycles, this cycle is entirely different than anything I've seen in over 40 years, which is that housing stock that would have in a normal circumstance dropped in value as mortgage rates doubled from 2.5, well, more than doubled actually, from 2.5 to 6.5. And the reason that didn't occur is because too many people who own homes now have chosen to sit still, not sell, because they don't want to trade that 2 and 3% mortgage and go into something that's going to be 6, maybe 7, even if they have a lot of equity and they otherwise would like to sell, maybe get a bigger home, move to another location, what have you, they're locked in. They don't want to do that. So what's happened is this sort of odd combination of mortgage rates have gone way up in a relative sense, because I'll argue still mortgage rates, generally speaking, historically are not that bad.
Mm-hmm.
But even though they've gone up a whole bunch, we haven't seen enough increase in inventory that normally would be triggered by elevated mortgage rates, because too many of those existing homeowners, that existing housing stock has such cheap money secured by it, they don't want to sell. So we've got this lockup situation, low inventory, high rates. What has that done? Home values keep creeping up. Even this past year, they're up like over 4% annually. And it's expected they're going to go up at a slower rate in 25, but they're still expected to go up probably in the 2 to 3% range, maybe 4. So, and if we're still going to be looking at rates that most likely are going to be in the 6s all of next year, this kind of environment is likely going to continue for an extended period of time.
One thing I want to ask you, and this may be just a little out of your zone of knowledge, but maybe not, is typically when the rates are low, like they were for quite some time, aren't home builders just absolutely just building like crazy, meaning that would have helped the inventory? Or we were just so far behind the 8 ball as an industry that said no matter how fast they built, they just could not produce enough inventory? Or were they caught in that cycle of not realizing that the people who had the low interest rates had no interest, no pun intended, of selling their home? So that future inventory of turnover was evaporated and they just couldn't build enough?
Yeah, I think that could be part of it. The home builders do kind of project out quite a bit. They definitely do try to plan out 2 years, 3 years, 5 years. During that low point, during the pandemic, I think there was more of an effort to try to get some more homes built. But then, of course, we did have those higher rates occur that did dampen demand somewhat, because, again, home builders don't have a home to sell before they build a new one. But at the same time, it takes a long time to build a home in a lot of markets. It's not like, okay, we're going to build 100 homes, and from the day you decide to build them, you're going to have them delivered in 6 months. It takes a lot longer. And of course, depending on the market and local government situation in terms of fees and permits and so forth, it can take quite a while to add to that inventory. And then, of course, if you have a situation where rates get elevated very quickly, again, I keep saying doubled in the last 3 or 4 years, or at least 2 and 3 years, then as they see that demand start to soften, then they start to recalibrate their plans to add too much inventory too quick, because the worst thing a home builder wants to have is standing inventory. That's the big no-no when you're building new homes. You don't want to have a bunch of standing inventory. So you have to kind of monitor that, what's going on in terms of demand and mortgage rates, and then compare that to, what do you think you can successfully build and get sold in a quick period of time. So, during or after the pandemic, as rates went up, we did see a shift where there was an increase in new home sales relative to existing home sales. That does seem to have moderated a little bit. This extended period of rates now snapping back up from where they were in September. I saw on the financial news this morning on CNBC, all the new home builder stock prices have dropped quite a bit the last couple of days. Like, we're talking 2, 3, 5% moves in the stock price in one day with this latest news. So home builders are going to see a pretty challenging market here in the next year or two. And I think the point is that I don't think they can build enough houses fast enough to be able to add to the inventory to make
Let's shift gears just a little bit, because
Go ahead.
No, that's all right. I apologize. I think we're having a little glitch there. I was ahead of you or behind you. I apologize.
Right.
You were saying you don't think they're going to have enough time to build enough inventory?
Well, yeah. I mean, the amount of inventory that is needed to cover current demand and to have some impact on maybe moderating home prices to where they don't rise as much, or maybe even stabilize, flatten out, or even drop a little bit, they're so far behind the curve that I don't think we can rely on just new home builders to cover that gap, that shortfall. What we need in terms of inventory is we need more of the existing housing stock to get their house on the market and sell. there's a lockup there. All of these homeowners at 2 and 3% more. I talk to them almost every day. It seems like I just talked to somebody yesterday. She's going to help her girlfriend buy a house, and but she, of course, as we're talking about that, she comments about, you gave me a 2 3/4 mortgage. We're not going anywhere. Well, I mean, that's the prevalent, mindset among homeowners out there, and unfortunately, until that changes, which is going to require mortgage rates to get from where we're at now in the sixes, probably, I would argue, under 5. If we can get under 5, then some of that housing stock will free up, and that will be the best, quickest way to help deal with this shortage of inventory and help provide home buyers something to buy, and hopefully will maybe moderate prices. However, I keep saying mortgage rates get too much better and they get under 5, I think that's going to push values back up because the demand for housing will probably outstrip the increase in supply.
Well, I'd have to change the thing. It said, isn't the rate Art says going down a good thing? No, because then the cost of homes go up because the demand goes up. So right. It's a tight wire. So just shifting gears a little bit, you mentioned about the rates being stable for a long time going forward as far as home loan interest rates. What do you think about the Fed? Do we look at more Fed rate cuts in 2025, and will that hamper the mortgage market?
Well, I don't think it'll hamper the mortgage market, but in 2025, what I think everyone needs to realize, yes, the Fed will probably lower the Fed funds rate maybe twice. I mean, before yesterday's meeting concluded, the forecast for 2025 was that the Fed was going to lower the Fed funds rate 4 times. Now they're backtracking and saying it's probably only going to be 2 times. That's the current bet in the financial markets. So that will, as a result, that is a signal the Fed, as I said earlier, is going to go slower and be less aggressive in reducing the Fed funds rate. That is part of the reason why longer-term rates, the bond yield and longer-term rates, are going to remain elevated. We're going to be in this 6+ mortgage interest rate environment, I would argue, for an extended period of time. All the major market participants, Fannie Mae, Freddie Mac, MBA, et cetera, National Association of Realtors, are all in various degrees forecasting we're going to be in the 6s all of next year. And so maybe in 26, we might see some improvement, get under 6. It could be 27 before we could see some real improvement in rates. So as a consequence, I continue to say, if you're a prospective home buyer, you want to buy a home, but you think it's not affordable, I would argue check with somebody like us. Let us first help you determine if you can afford it, if you can at least qualify for the financing. And then I would argue you're better off not waiting any longer, because waiting so far hasn't paid off. And I think from all viewpoints, waiting some more is probably not going to pay off in terms of rates getting as low as you're expecting them to go. So you've got to figure out some other strategies to get into housing now if you want to. Again, I'm not trying to suggest anybody should try to buy a house if they're not able to afford it. That's where we come in. We can tell you if you can or not. But there's a lot of folks out there who I think would like to buy a home. They've convinced themselves that they can't qualify for it. Now, maybe they don't want the payment they can qualify for. That's a different issue. But I can help you. We can help you make that determination. Number one, determine, can you qualify? And then, of course, we can help you and be a sounding board for you, so we can discuss, do you want to qualify at today's rates and today's note rates, I'll say, because as I keep harping on, a great strategy in this environment is to take advantage of home ownership if you want to, and we can determine you qualify for it, and then use a buy down strategy to give you some payment relief for up to 3 years. I think that is a great strategy. Well,
that pretty much takes us right to the next question, which is, since you're forecasting, or it's being forecasted, the rates will be higher for longer, what are you telling prospective homebuyers to do when they kind of face this? Because I've listened to your show every week, and I was looking at my notes before we got started today, and the forecast for home prices, I'm just going to pull it up here real quick. It said 8 to 20% over the next 5 years as far as home growth is concerned. So waiting doesn't sound like it's a good idea. So what are you telling them to do? You kind of hinted at that a little bit.
Well, I did. Yeah. Again, I think the buy down strategy is the way to go. In fact, I've got a little slide here prepared that I want, Jeff, for you to pull up, because I want to give everybody another example. I know I've done this before, but this is a real-time current example This is what I'm going to show you is some numbers based on a property that I found on the MLS system listed right here in the Palm Springs area to try to illustrate for you how a temporary buy down can really work to your advantage. What I found here was a single family residence with 4 bedrooms, 2 baths in 2,343 square feet with a pool and spa on a 9,100 square foot lot. It's listed for $899,000. It's been on the market for 84 days with no offers and no reduction in the list price. The listing says that it's been updated, remodeled, and it comes fully furnished. Sounds like a pretty good property, right? Well, let's first look at what would the financing look like if you made a full price offer. Well, at a full price offer at $899, if you're going to put, let's say, 25% down, your loan amount's going to be $674, and you're going to be seeing a principal and interest using a 6 5/8 interest rate for 30-year fix at $43.51. So yeah, for some folks that may be a pretty big number to bite into. So what is the most common strategy that folks look to do when they're looking at a listing like this that is getting to be what we call stale? Well, they'll say, aha, we think we can get a concession from the seller. So they talk to their agent. They think, well, we're going to offer $30,000 under the list price. So we're going to offer $869, not $899. Well, with 25% down still, the loan amount's going to drop to $651 from that $674. And your principal and interest at the same rate, $41.68. Now that's $183 a month lower than a full price offer. Makes some sense. That is some benefit, right? $183 isn't bad, although it's not huge. So my point is, rather than considering that strategy of just offering a lower price under list, instead consider offering full price, $899, and instead ask for a seller credit of that $30,000. So you're getting money from the seller from their proceeds. Use that $30,000 to fund a 3-2-1 buy down. Your loan amount will be back to that 674 level with 25% down because, again, you're offering full price. And remember that at the note rate at 6 5/8, the principal and interest is going to be $43.51. But you won't hit that payment until year 4. The first year, that 3% buy down, you're going to be at 3 5/8. Your principal and interest is going to be $3,074. That's $1,242 a month lower for the first year. First 12 months, you're going to pay $1,242 a month lower over that first year. Second year at 4 5/8, $850 lower for 12 months. Third year at 5 5/8, $436 a month lower for 12 months. Over that 3-year span, you're going to save $30,000 in principal and interest payments. That is huge, and certainly a lot more benefit than using that $30,000 in a sale price reduction where you're getting $183 a month lower payment on the mortgage. Here, with that same $30,000 concession used a different way, buying down your rate, your savings per month is substantially greater than just getting a lower sale price from offering $30,000 under. So the point of this is temporary buy downs at full price feature superior payment terms over a lower price offer. So again, if you want to buy, if we can help you determine you're able to qualify to buy, of course, again, buy downs are not qualifying tools. They're a tool to help you get a relief, a benefit from a lower payment over a 3-year period. And remember, we can do 2-1 buy downs as well for 2 years. But the point is, this is not a qualifying tool. It's a way for you to get rate and payment relief for 2 to 3 years so that you can get into home ownership now based on us determining you can qualify at the note rate. And then you have that 2 to 3 year window to refinance your loan and get a lower note rate when rates do fall over that next 2 and 3 years, which is still being predicted. So this is another great example why don't wait. If you want to buy, we can help you do that now. Take advantage of home ownership so that you can enjoy that appreciation that will occur when rates fall significantly in the next 2 to 3 years.
Art, I just have to jump back in here and ask you a couple of questions here because, first of all, in the first 3 years, because I'm paying that much lower in my payment, does that mean I don't get to use the house the same way?
Well, no, you can certainly use the house the same way. That's a separate issue. I mean, the whole point of this is you're basically using the seller's money to subsidize your interest rate and your monthly mortgage payment for that 6-month term. But otherwise, use the house as you would normally use it anyway. Now, again, these numbers are based on buying the home as your primary residence. We can do a temporary buy down on a second home. An investment property is a little tricky because the concession limit for investment property is only 2% of the purchase price. So there's not much room to get seller concessions for this type of buy down. But for a primary home, this is a terrific way to use that $30,000 concession from the seller in a much more effective way for you, the buyer, in terms of lowering your monthly housing expense for 3 years.
Well, let me ask you this. Let's just play a little what if game here. Okay. During that next 3 years where I'm getting anywhere from $1,200 a month less in payments for a year down to the worst case scenario, $436 a month. During that period of time, do you think we're going to see some equity growth in that property?
Yes, as I mentioned earlier, the forecast for 2025 is that we're still going to see home price values increasing, probably somewhere in the 2 to 4% range. Now, not huge, but the point is, appreciation in home values is still expected to occur even with these conditions that are predicted to be in place for all of 25 and beyond. Remember what you read earlier. An earlier study indicated that over the next 5 years, home price appreciation, home value appreciation is expected to increase at the low side about 8%, high side up to 20%. So why wouldn't you consider, again, if you can qualify, I'm not trying to force anybody to try to qualify for something they can't afford. If you can qualify and we can help you determine that, why wouldn't you try to take advantage of that rather than just spending your money on rent and not being able to cash in on that appreciation?
Well, and the last what if is this. In that period of time, is there a chance that the rates will then go down enough that I could lock in a permanent rate situation?
Absolutely. Again, it was just 3 months ago, we were offering conforming 30-year fixed rates, not at 6 5/8, but at 5.5, just 3 months ago. So it's not like that couldn't happen again. Now, again, the forecasts are we're probably going to be 6+ for better part of next year. But I would expect, my forecast would be that is probably a accurate forecast, but certainly going into 2026, I think we will probably see a scenario where we'll get back under 6. And if you're at 6 5/8, once you get into the mid 5s or better, that starts to become an opportunity to refi. So I think, yes, within a 3-year period, you are going to have that opportunity to refi your note rate, and it's going to be probably something, at least mid 5s. And of course, fingers crossed, what we really hope is you can get under 5. And if that occurs within the next 3 years, that's when you do the refi and get that lower rate note rate for the remaining. Actually, what would happen is you'd extend out a new loan for 30 years. And by the way, if you do that before your buy down period is over, any of the buy down money that hasn't been used yet because you haven't finished that 36-month period, you don't lose that money. You will get that money from the lender. Either they'll send you a check, which is not that common anymore. Instead, what they'll do is they'll apply the remaining funds in the buy down account towards your mortgage payoff when you do that refi. So you still get the benefit of that money.
Art, it just sounds like this is a no lose situation. I know in the past you've called it. I didn't want to say you hold all the aces, but what do you call that?
One-sided bet.
A one-sided bet. I love that. This just makes so much sense. The use of money and how, if you know how to use money, in this case, somebody else's money to buy down that the interest rate temporarily. I mean, come on. All of a sudden, now I can go out and get a loan for 3.625%.
Right.
I mean, that's just amazing. And that seems like those are the conversations. You tell me that you have people, the reason they're not buying is because interest rate is too high, but this allows them to take advantage of it right now.
Exactly. This allows them to get that rate in the 3s that they've been waiting for, which unfortunately I don't think we're going to see anytime soon. But this is a way they can get that rate at least for the first year. And again, 4 5/8 the second year is pretty good, and 5 5/8 the third year is pretty good. 3 years is a long time. So that kind of benefit in rate and lower payment, I think is huge. And why wouldn't you take advantage of that if we can otherwise determine you can qualify for that note rate? That way, you're set up for two options. As mortgage rates fall, refinance your note rate into into a lower rate for another 30 years. Or if you're getting uncomfortable with that fourth year coming up, your home price probably is appreciated anyway. Worst case, sell the house, cash in on that equity buildup, and then regroup and see where you go from there.
Start again. Well, Art, thank you very much. This has been a great session, and really being able to kind of peel this thing back like an artichoke and talk a little bit more about it, and understand that you don't have to wait because we're only going to see appreciation, meaning the house prices or home prices are going to be more expensive, and you don't have to wait to get the rates you want. I'm going to put your number on the screen there, Art. That's 760-969-5023. That's his office number. Give Art a call today, because this is not a made up scenario, is it? This is a live scenario really happening in our market today, is it not?
It is. This is an example based on a listing I just looked at yesterday. So if anybody's interested in this particular house in Palm Springs, call me and I'll be happy to give you the address and you can look into it. And I certainly can put some numbers together for you for this kind of buy down strategy.
Art, thank you very much. I'll turn it back over to you. Let's have a great finish here.
All right. Thank you. Okay, thanks, Jeff. The next thing I want to talk about real quick here is regarding this Fed decision, where this has been a benefit to the mortgage market, I would argue, is equity loans. And the reason I say that is equity loans are generally shorter term loans. And because the Fed funds rate is a shorter term rate, there's a more of a direct correlation to equity loans. So equity loans, I think, are and will continue to be a bright spot in the mortgage industry. Part of the reason, residential home equity. As of the third quarter of 2024, residential home equity is now over $17 trillion. That is a huge, huge number, all-time record almost. And so the point of that is representative of the current housing stock, where such a high percentage of homeowners have kept their homes. They've not put them on the market, which has caused that tight inventory, which has kept home prices elevated for those trying to buy a home. But for current homeowners, that equity buildup is a huge, huge opportunity, and equity loans are designed to help that homeowner take advantage of that. So I wanted to give you just a few examples of the kind of rates that are currently available on home equity loans. And let me give you some assumptions. 760 credit score, loan to value of 65% to 80%, and a 20-year term. So let me give you first the kind of rates that we can offer you on what's called a fixed line HELOC. This type of a HELOC is very unique. It's a fixed rate loan, not a variable rate loan. The most common term chosen is a 20-year term. That's the sweet spot. So you get a loan that's fixed for 20 years, but it is a HELOC. You can draw on the unused portion during the first 3 years. And as you pay down the balance, your monthly mortgage payment, your minimum monthly mortgage payment, does get recast lower the following month. That's unique for a fixed rate loan. And look there, based on these parameters I'm giving you, the rate can range from 7.09 to about 8.75. Those are very good for second mortgage rates, which are always going to be higher than first mortgage rates anyway. And those rates are not substantially higher than where first mortgage rates are. So those are very, very good. And again, about 1% lower than where they were just 3 months ago when the Fed funds rate was 1% higher. For a variable rate HELOC, this is the more traditional HELOC where it's tied to the prime rate. You're going to have a margin over prime, and it will adjust anytime the Fed funds rate changes, which, of course, the reason you would consider a variable rate HELOC is because even though the Fed's expected reductions in the Fed funds rate is more modest of 2 times each at 0.25% next year, that's still a 0.5% improvement. So if you get a HELOC now, pretty good bet you're going to see an improvement in that rate over the next 12 months. So a variable rate HELOC, again, with these assumptions we have at the top, rates are ranging from 7 7/8 to 8.5. Again, very good rates for HELOCs compared to where they were 3 months ago or earlier. And then for fixed rate equity loans, again, this is the more traditional fixed rate loan where you get the money all at once. Right now, we can offer a fixed rate loan based on these same assumptions, ranging from 6.99 to 8.375. And all of these, by the way, are based on a $100,000 loan amount. So these are terrific rates if you want to pull cash equity out of your home to use for just about any purpose. Remodel your home, build an ADU, maybe use the funds to buy a rental property. There's all kinds of uses for these equity loans. And for those of you who've decided you don't want to sell because you don't want to have to choke down those higher first mortgage rates on a new home purchase loan, you consider these HELOCs and these equity loans as a way to tap into your equity and improve your housing situation where you're at now. The last thing I want to point out is the secondary financing we have for 55 plus homeowners. It's called a Home Safe Second. This is for homeowners who are 55 plus. And this one has a decrease in rates that just occurred. Now you can get from 8.99 to 9.49. What's unique about this second mortgage type is it's a reverse mortgage-like product. In other words, after you get the loan, you can choose to make payments when you want to. It's not required to make payments. Yes, the loan balance will grow over time, but if you would prefer to avoid that or at least minimize that, you can make payments if you want. So the point is, it gives you payment flexibility. So I want you to just understand that all of these types of loan programs are available for those of you who have enjoyed a big increase in your equity. So with that, let's go to the closing question from last week. We have a significant amount of student loan debt that is deferred, and we're considering a home purchase. How is this debt accounted for when qualifying for the loan? Well, we run into this a lot of times. Many of you may have student loans. They may be in deferment. So you think if you're going to get a mortgage, we can just ignore that because there's no payment reported on your credit report. Unfortunately, that's not true. We do have to consider that debt and come up with an assumed payment depending on the type of loan you're getting. And then that assumed monthly payment is included when we're calculating your debt ratio. But the type of loan you're getting will determine how that debt is treated. For a Fannie Mae conforming loan or a conventional jumbo loan, we're going to calculate the assumed payment at 1% of the student loan balance. For Freddie Mac conforming and FHA or USDA, it's going to be 0.5% of the loan balance. And then for VA loans, what we do is we take 5% of the loan balance, divide it by 12 to come up with the assumed monthly payment. Now, in addition to these options, depending on loan type, if you're able to document what the minimum payment will be on that student loan that was deferred, if you can provide that documentation, we can use that. And sometimes that will be lower than these calculations I'm showing you. So just understand that if you have student loan debt, we can't ignore it, but this is the way it's going to be treated. And certainly if it's a loan type where we can count 0.5% of the balance instead of 1%, you're better off, obviously. And VA loans, that formula actually results in a very low monthly payment to be included in your debt ratio. So of course, therefore, VA loans treat these deferred student loans in a much more kinder way than the other loan types. So good question. And with that, I'm going to go to the closing question for next week. Pretty interesting one. Can gambling income be considered as qualifying income when applying for the mortgage? So stay tuned for our next edition of Mortgage Minute, where I'll give you the answer to that question, and it'll be on the house. In the meantime, I want to wish everyone a happy holiday and Merry Christmas. The next 2 weeks, of course, on Thursday will be right around Christmas and New Year's, so we'll probably have a recorded show for those next 2 weeks. So I'll see you back here first of the year in 2025. In the meantime, I want to thank you for watching and listening. My name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house. So long. Take care.